There are two main types of investments available: equities and bonds. An equity is another term for shares in a particular company. It's what usually comes to mind when someone talks about investing. You buy shares in a company and hope to profit from their growth. The aim is to earn a return in the form of capital growth, income from the payment of dividends, or a combination of both. Dividends are sums of money paid to shareholders as a reward by a company out of its profits or revenues. Of course, nothing is guaranteed, and companies can do better or worse. This causes the share price to fluctuate and therefore the value of your holding. Take the example of buying 10 shares at £5 each. You will have invested £50. If the share price rises to £6, then the stake will be worth £60. Of course, it can also go down. If the share price drops, then the value of your investment will also go down, although keep in mind the loss is only on paper until you crystallize it by selling the stock. Therefore, even though investing in shares or equities can be potentially rewarding, it does come with a fair degree of risk attached. The second main type of investment is a bond. The best way to think about a bond is an IOU. You are effectively loaning money to the bond issuer, which can be a company or government. In exchange, you'll receive a fixed rate of interest over a predetermined period, as well as your original investment returned on a specified future date. They are seen as less risky than equities, therefore holding them helps reduce the overall risk in an investment portfolio, as well as producing a level of income. I wish I could leave it there, but it's not quite that simple. There are different types of bonds, because of course there are. Which is most suitable to you will depend on what you're trying to achieve and your attitude towards risk. First stop are government bonds. These are seen as the safest type of bonds as long as they're issued by countries with stable administrations who are likely to pay the money back. Of course, this can be a blessing and a curse. While the money you've invested should be relatively safe, the lack of risk means they offer a lower rate of interest than racier bonds from emerging markets, for example. Bonds issued by the UK government are known as gilts, a shortened version of gilt-edged securities, referring to when certificates were gilt-edged. And US government bonds are often called treasuries. Then there are corporate bonds, where you're lending money to a company rather than a government. This means they can be riskier. The reality is there's no guarantee your investment will be repaid in full because the company issuing the bond may encounter problems paying its interest payments or even go bust. Therefore, while they're generally regarded as being safer than equities, analysis and research are still required before committing your cash to a bond. To help you assess the potential risk of bonds, specialist credit agencies assess them and apply a rating based on the issuer's ability and likelihood of paying back the sum borrowed. The most trusted will be given a AAA rating. Then it will go down on a sliding scale through AA, A, and BBB. Generally, any bonds rated BBB or higher will be classified as investment grade, whereas anything below will be known as high yield. This is because riskier bonds need to offer a higher yield to investors in order to tempt them to invest in the first place. The more risk you're willing to take, the higher your potential returns. Generally speaking, government bonds are the safest, followed by investment grade and then high yield.